So in this video, after we understand how to measure the money market, so now we're gonna start to learn how the monetary policy gonna affect our macroeconomic outcomes. So we will discuss the monetary stimulus and the monetary restraints. And especially we want to look at the policy constraints. So what's the limitation of what we're gonna use? What's the policy limitation for the monetary policies? So first of all, we have to mention lowering interest rates actually is a tactic of the monetary stimulus to increase aggregate demand. So how so? So think about if the interest rate is low, for you, what you gonna do? Yes, you're gonna go to the bank, get the loan, buy the car, buy the houses. So because the interest rate is so low, why not? And especially if the interest rate will be lower. Think about it, sometimes in the close to the New Year, Christmas. So they will say, oh, the interest to borrow to buy a car, the interest will be 0%. And you can see that's actually considered as a marketing tool to help to sell more cars. So people is reacting to the changing of the interest rate. So the lower interest rate, and what we found is lower interest rate will reduce the cost of the investment spending and also reduce the cost of the holding the inventory. And the investment spending increase will kick off a positive multiplier effect, and aggregated demand will shift to right because of this. So the ideal case, lower interest rates and actually will help to will help to increase aggregate demand curve. So now think how it works. So first of all, government has to increase the money supply. Increase the money supply, as we discussed, will lower the interest rate. So lower the interest rate will allow to reduce the cost of the investment, the holding the inventory, and eventually will create a positive multiplier effect and push our AD curve shift to the right. So this is how the monetary policy can play a role as stimulus. How about so actually rising the interest rate is a tactic of the monetary restraint to decrease aggregate demand. So it's a very opposite scenario, and if you understand the relationship between decreasing interest rate, increasing aggregate demand, and you should be understand increasing interest rate and decreasing aggregate demand. Because increasing the interest rates, it will make borrowing more expensive. So in another way, so increase the cost of the investment spending and increase the cost of holding the inventory. So the investment the spending decrease will kick off a negative multiplier effect. So aggregate the supply demand curve will shift left because of this. So generally speaking, so first of all, you need to rise in the interest rate. For the Fed perspective, so they will decrease the money supply. We already see supply and demand curve for the money. So decreased money supply will push the equilibrium interest rate up. So rising interest rates and it will make the borrowing more expensive, and so people less likely to invest, they're less likely to hold inventory. So then they will generate this kind of negative multiplier effect, and we eventually will push our aggregate demand curve to the left. So to summarize, so if the goal is to stimulate the economy, what we see is the federal government will increase the money supply, and which in turn will lead to the lower interest rate, which lead to the increasing in aggregate demand. So this happened at the beginning of the 2016, and so the government and the Fed lowering the interest rates by increasing the increasing money supply, and so this you can see is try to recovering our economy. So try to boost the economy, and so this is the stimulate the economy. So for the opposite case, if the goal for the government is try to restrain the economy, so what they should do is decrease the money supply, which will lead to the higher interest rate and which will lead to a decrease in aggregate demand. So this is how it works when we talk about the monetary policy, monetary stimulus, monetary strengths. And the goal here is how the changing of the money supply will affect interest rates and which are going to further affect our aggregate demand. So in next video, we will talk about what is the limitation for these monetary policies. And so we will discuss a lot of things. And after that, we'll talk about the monetaristic perspective.